Hey, everybody, it's Brian Kasal. I'm here to announce our podcast episode here for today's Market Explained. We are down in Mexico at our conference. We meet twice a year as a firm with all the advisors, lots of program sponsors, mutual fund sponsors, systems apps, custody banks, all kinds of different people. And I managed to get four of the program sponsors down for an interview. So we did this last year as well, and did this at a lot of our conferences, and it's a good way to see different types of programs that are out there. And so, four interviews. Here we go with our next episode. Enjoy.
Hey, everybody. It's Brian Kasal, and I'm back here with today's Market Explained. We are down in Mexico, and we do an annual conference down here in December. We're at a Hotel Atelier, which is just north of Cancun, and we have our advisors, four-star advisors, some guest advisors, and we have a lot of sponsors, investment people. We're down here for professional development, learn about investments, learn about how to do better things for our clients. So we're going to interview some sponsors, and today we've got Tim Donovan. Tim, you're with a group called Midlock out of Chicago, right?
Yeah.
Okay, and that's our home city. We're Chicago as well.
Yeah.
Great. Well, so Tim, why are you here at the Four-Star Conference, and then what are you offering to folks?
Yeah, absolutely. So I'm with Midlock Investment Partners. As Brian mentioned, we're a Chicago-based private real estate company. Essentially meaning that we go and we, through relationships with great wealth advisors like Brian and his team, pool investor capital together to go and buy private real estate assets.
Okay.
So we do that in what we call the small to middle market. So it's deals too big for an individual to buy, but smaller than what institutional capital chases. And we found that within that subset of alternative investments, which there are a lot of different alternatives to obviously pursue. But we find that to be a really attractive risk-adjusted return. We can not only produce strong cash yields for our investors, but we can also do it in a tax-advantaged way. And there's also a lot of appreciation opportunities and other ways to make strong returns, while also mitigating risk within the real estate space.
Right. So like the stock market average is about 10%, right?
Yep.
And the bond market average is about 3%. So what kind of, for the risk you take with real estate, what might you expect as a return? More north of 10?
The reality is it really depends on who you're investing with and what their business plan is.
Okay.
Right. There's a lot of real estate that can be treated as a bond substitute, and there's a lot of real estate that's very opportunistic, like development or conversions. Where we play, we acquire buildings and we improve them to hopefully add income and add value. We're really targeting to earn a return between 13 and 17% annualized. But I think one difference with that, maybe over the stock market, that would maybe align a little bit more with bonds, would be a good portion of that comes from dividends that we pay our investors. So
Okay.
we're really trying to pay between a 6 and a 9% quarterly dividend.
Like a yield.
A yield,
Yeah, okay,
right?
great.
And so it works well for people that want exposure to an asset class that earns maybe an all-in return higher than what you can get in the stock market, but also produces income along the way.
Okay, great. And so then, all right, so then there's income along the way, and then eventually what happens to the investment? Like, how long are we in it? And
Yep.
how do we, you can't really sell it, right? So,
Yeah.
okay.
And that's probably the biggest, I would say, drawback, right? Versus investing in public equities and certain fixed income, is real estate is inherently illiquid, right? You can certainly always sell a property, but you can't sell it overnight like you can with some stocks. So typically speaking, what we sort of say for our investment strategy is we're investing in projects and reinvesting for about a 5-year period. And then once we sort of hit that period, as we sell assets, or we refinance assets and pull money out, we use that to then give investor capital back. So it's always a balance between selling assets once you've completed your business model and returning capital that way, but then also making sure that you're building a good asset base to continue paying distributions.
So let's say we have good success. The properties could be sold, sooner, maybe 3 to 5 years.
Yep.
But if things are a little slower, it might take longer than that, right?
Correct.
It could be
Yep.
5 to 7 years, maybe, or more. So that's undefined, right? That's the
Correct.
undefined part. Okay, but we should be able to get better returns than stocks. But the other thing is it's a different return, right? It's not like a stock. It's not like a bond. So what's the advantage of that?
It's one of those that the real estate does not inherently correlate with the stock market. And again, I think the big thing that you maybe miss out on in the bond or the stock market is really then the tax benefits.
Yeah.
So right? We can pay obviously distributions and the property appreciates in value, but real estate gets special tax treatment through what's called bonus depreciation,
Okay.
where you can actually basically shelter a lot of your income
Okay.
through your real estate and convert it into capital gains.
Right.
So it tends to be a little bit more tax advantage. And I think
Okay.
one of the things, right, liquidity is a little bit of a double-edged sword. There's not a lot of liquidity or as much liquidity in real estate, but at the same time, it makes it a little bit harder to be an emotional seller.
Right.
Right. We can be patient. Right. If so long as you're not in a position where you're forced to sell, because it's a little more liquid, you can take the emotion out of the investing and you can really look at things holistically and be patient to sell when the market's right, not when you're maybe worried about movement in interest rates or a certain stock having a bad earnings call. Real estate, I think, is a little bit smoother because of the duration.
Right. Okay. So then, if we have a portfolio of stocks and bonds, then we can put money into these programs, but we can't put a lot into them. Like you can't put your whole portfolio in it
Correct.
because then you'd have no liquidity, right?
Correct.
Okay. So maybe there's some number that works 30, 40% or something like that. Everybody has a different number. But that segment hopefully will get better returns. So you take your portfolio of stocks and bonds, you get better returns because you add in an asset class that's doing better at certain percentages, right?
Yep. Exactly.
That's great. That's good. Well, good. Anything else unique about Midlock? Yeah, I know you have multi-asset classes in one portfolio, right?
Yeah. I think one of the things that we really put a lot of emphasis on at Midlock is having diversification for our investors. You'll see in the real estate world, it's a very local game. There's a lot of groups that either only invest in one market or maybe only invest one asset class. And that certainly can be a good strategy, but our belief is that our investors should really try to have exposure outside of maybe just one geography or one property type. Right. At any given time, certain markets can overperform, underperform. Same thing with asset classes. So when you look at Midlock's portfolio, we're about 40% apartments, about 40% industrial, and that last 20% is sort of a mix between retail and other commercial property types. And then we invest around the country as well. We're investing predominantly Midwest. That's where we're based, and that's where we have the most relationships. But we also own in some of the West Coast markets, a little bit on kind of the Southeast. But so we're a little bit unique in the fact that we're not only necessarily providing the alternative real estate investment, but we also can be a little bit of a one-stop shop for wealth advisors, family offices, individuals who would like diversification without having to go and find 10 projects to invest in.
So then your team decides, hey, we're going to put a lot more in industrial and less in multifamily now, or we see opportunities in hotels or something different. You can make all those decisions.
Exactly. Those are the conversations that we're having day in and day out. The reality is there's good investments to be had really in any time. It's just about being selective around those. So there are points in time where we say, hey, we think the market's really underappreciating the value of industrial in a certain market, right? And we can kind of pivot our strategy, or at the same time too, hey, apartments are a little overvalued in some markets. We're going to really stop focusing on that, and we're going to wait for things to change in that market. So we're fairly dynamic investors, and again, we're looking at it from a whole portfolio level of saying, where is capital flowing? Where is there risk in the market? And how can we generate the most stable 13 to 17% return? But a big piece of that I think is often left out is how do we do that while minimizing risk along the way?
Right. Excellent. And Tim, how have you guys done? You've done it a long time. What are the results been? Pretty good?
Yeah, so we've been fortunate at Midlock. We started our funds back in 2019. Since then, we've done about $1 billion worth of historical transactions. Again, we're targeting the 13 to 17, so it's not totally repeatable necessarily, but deals that we have sold to date, it's been about 15 properties that we've done a full cycle on. Those have averaged about a 1.9 equity multiple. So for every $100,000, we've returned about 190.
Wow.
And it's been about a 41% annualized return.
Wow.
And so we're proud of that track record. It's obviously some of those times were good, some of those times were not so good for investing. So we've been able to sort of prove our strategy through kind of the ups and downs of the market.
Long cycles. That's great. Well, good. Well, and I'll put this out to our guests here, and investors who are watching that, you have to talk to your financial advisor to see if this is the right thing for you based on your portfolio. There's all those disclaimers, of course, that go with it. But, it wouldn't be a bad thing to look at properties like this. If you have the capacity, it's the right thing. And Midlock could be a great partner.
Absolutely.
Yeah.
Well, I appreciate you
So,
having us.
Thank you. Thanks for being with us today
Yeah,
on today's Market Explained. Thanks, Tim.
absolutely. Thanks.
All right. Thank you so much. Thanks, folks. And we'll be back again shortly with another interview. Thank you. Hey, welcome back, everybody. We're doing our interview series. Here we are down in Cancun at the Hotel Atelier with the 4-star winter conference. And we're down here for professional development. We're meeting lots of different investment sponsors so we can bring new ideas to our investors. We have 45 advisors down here. And so we're interviewing some of our investment sponsors. And this gentleman to my right is no stranger to today's Market Explained and 4-star. P Suit, welcome to the 4-star.
Thank you, Brian. Appreciate it. It has been a pleasure to be here and be a part of the 4-star. Well, imagine you guys have had amazing growth, and we have been privileged and honored to be a part of it.
Well, thank you. Glad you're here. So P Suit, tell our listeners what program you have, like an anchor on your shirt, right? So
Yeah.
it's called, I think it's Anchorado, right?
Like,
Okay. So tell us, what is Anchorado? What do you do, and how do investors benefit from that?
So at Ancorado, which means it's anchored in Italian, but Ancorado, we are a third-party money manager. What we do is we provide objective-oriented portfolios, SMAs, that utilize structured notes as the underlying assets.
Okay.
Right. So each of our SMAs are designed to meet either a certain objective, whether it's income or growth, and they're also categorized based on risk.
Mhm.
So we have really 3 primary categories of our portfolios: our
Okay.
conservative, our moderate, and our aggressive. And our conservative strategies, we only use what's called a broad-based indices as analyzed.
Okay.
On our moderate strategies, we'll use a combination of broad-based indices and sector ETFs as the analyzed.
Okay.
And then our aggressive strategies, we'll use individual stocks. And those are primarily the only area
Mhm.
and the only category that we'll use individual stocks, because even though you can get amazing performance, you can also get a lot of volatility with individual stocks. So we leave that primarily in just our aggressive bucket.
Okay. So what is a structured note, P Suit?
It's a great question. Structured notes have been around for a very long time. Started first in the 1980s in Europe, then in the 90s migrated to Asia and Latin America, Canada, and all around. And now really in the 2000s, it started to come and become more prolific here in the US.
Okay.
This year, we're about to hit $200 billion in the US.
Wow.
Last year, was 150 billion, which, by the way, sounds like a lot. That's a drop in the bucket.
Compared to the regular
Yeah.
bond market. Yeah.
Compared to the structured note market globally.
Right.
It's a $3 trillion market.
Wow.
And what it is you mentioned bonds. So structured notes is essentially it's a hybrid security that is a combination of bond with derivatives on top of it.
With some equity features to it, right? Okay. So then why would someone do a structured note?
Structured notes can provide compelling opportunities and returns for clients. They can create a very specific objective. Like, let's say our fixed income strategy, which is our flagship strategy.
Mhm.
That strategy is designed to generate low to mid-teens
Okay.
current income each year. So
Okay.
each of the notes that we purchase and create for that portfolio is designed to do exactly that: provide consistent monthly or quarterly cash flow. And if the notes and their parameters are met every single month, those coupons are paid. And right now in that strategy, we actually have, I think, an average total annualized return of 10.6% net of fees
Net of fees.
since
Okay.
2019.
Nice. Okay. So you're saying 10%. Now the bond market, they just lowered rates again today, actually, today was
Yep.
Fed day. And but the bond market's paying what, 5 or 6?
Right.
So this is like double.
In some instances, even more.
Even more. So that might be one reason. And then also you get some equity participation in some of these notes,
Correct.
but then it's complicated, right? So then does the investor have to worry about that, or is that part of your role in running these portfolios?
That's a very good question. Normally, if you're an advisor and you're buying onesie, twosie notes on your own, the note matures or gets called, you as the advisor now have to go and have to redeploy the capital. You have to make sure it's not sitting in cash. There's a lot of work that the advisors have to do when notes get called or when they mature. When they partner with us at Ancorado, we do all of it. None of the advisors have to do anything. When note gets called, we do all the rebalancing. We do all of the deployment. The clients have to sign a new paperwork. That's literally what we try to do, is we try to make this as easy for both the advisors and the clients as possible to meet the objectives of which you're trying to meet.
So it's like a mutual fund of these notes, right? Essentially, kind of, or a separate account that's that way.
Correct. Yeah, I think that the easiest way to conceptualize it is exactly that. It's a mutual fund, but with structured products.
Okay.
However, like a mutual fund that has, one one ticker that you usually invest into. These are SMAs, so they are separate managed accounts. So there's a little bit more of a setup process to create the account, but when it's done, it's as easy as a mutual fund there afterwards.
Yes, very interesting. So then an investor who has money, like we try to separate between like risky and conservative, like safe bucket, growth bucket. So this would be closer to the safer bucket because it's like bonds.
Yeah.
But you wouldn't put all your money in it, but you could put some of your safe bucket in there and still have some bonds and cash and things like CDs and things like that,
Yeah.
right? So
Well, again, like I said, we have three different categories. Our
Right.
conservative bucket, you could definitely use as, especially the income side, you could use it as a replacement or complement to your traditional fixed income strategy. But on the equity side, we have our aggressive growth strategy called opportunistic growth. And again, no past performance is no guarantee of future results. But that strategy, 2020, has netted over 36% per year to clients net of fees.
wow, that's great. That's
And
great.
the interesting part about growth oriented structured notes is unlike when you buy an equity, say you buy Apple 10 years ago. When do you sell? Most people don't, they get emotionally tied, they don't sell, they hold on to it forever, and you just never know when the right moment to sell it, right?
Exactly. Right.
I'm sure you've worked with hundreds of clients that done exactly that with a particular stock.
Yeah.
Well, with a structured note, you could create a structured note based off Apple. And let's say in 3 years at maturity, based off the performance of Apple, maybe another underlier or two. If it does well, you can have a multiplying effect on it called an accelerated note.
Okay.
So let's say you have a 3x multiplier at the end on the worst performer, and the worst performer is, let's say it's Apple. And Apple in 3 years grew by 30%. Now you multiply that by a 3x uncapped.
Right.
That is a 90% total return on that note.
Wow.
Potentially. Right?
Right.
And because it matures, you have to take the growth.
Okay.
It doesn't just sit in the account unrealized.
Oh, okay.
Yeah.
Okay. So let's say, so this is all great piece. Let's say we have an investor who wants to put some in. Is there like a minimum amount you have to put in the program?
There are. We have, again, in our three different categories, our conservative category has a $20,000 minimum, whether it's for a broad-based income strategy or a broad-based growth strategy. Those are our conservative portfolios. In our moderate portfolios, it's a $35,000 minimum per account. And that is our flagship fixed income. Again, that's our income strategy. And then our anchored growth strategy. That is our moderate growth strategy.
Okay.
And then in our aggressive strategy, because they're more aggressive and you need a more sophisticated investor for them, they require a $50,000 minimum.
Okay.
And
Okay.
our high income is the name of our high income strategy there, as well as opportunistic growth is the name of our aggressive growth strategy.
So not huge minimums for a portfolio investor. So not a bad way to go.
Yeah.
And so now, folks, as you consider doing something like an Anchor Auto portfolio, you'd have to talk to your advisor, make sure it's the right thing for you, and make sure you meet all the proper ratios of taking overweighting in one program versus another, all the prudent things that you might do. But it's something to consider for sure, isn't it? Yeah, it's really great. Well, good.
And Brian, if I may, since our last meeting, we actually have some other updates, which I forgot to mention to your team.
Okay.
We now have a nitrogen risk alliance score on our SMAs.
Oh, wow.
Yeah. So for ours,
Great.
as example, for our flagship strategy,
Okay.
again, this is netted 10.5% net of fees since 2019.
Okay.
We have a risk score of 34.
34.
Which,
Okay.
when you think about that, the entire parameter is up to 100.
Yes.
And the ag bond has a risk score of 29.
Okay.
For only 5 points more volatility,
Right.
we're almost doubling the yield of the ag bond.
Yeah.
Right.
And folks, that whole risk thing is a 0 to 100, 100 being the riskiest, like stocks and, commodities will be way up there. And so we're talking in the lower risk territory. And so it is kind of a good bond replacement or a bond addition kind of thing, right? That's right in that same territory. So that's great. That's a great thing to know. Well, thank you.
Well, no,
That's been great.
Then on our grade, because nitrogen also has a grade, we have a grade of 4.1 on fixed income, and they go up. Their highest grade you get is 4.3.
Oh, that's great.
Yeah.
That's great. Wow, that's really great. I did not know
That
those
was
right.
brand new as of last month.
Okay, that's great. So, folks, you're getting the sense of how this works and where it might fit into your portfolio. So, anyway, we were hoping to have a couple conversations like this, and thank you very much, Pete,
My pleasure.
for
Brian,
being with us
always a
today.
pleasure. Appreciate it.
Absolutely. All right, folks. Well, that's it on this interview. We'll be back with another one very shortly. Thanks, everybody. Bye-bye now. Brian Kasal. I'm the CEO and founder of 4-Star Wealth Advisors. Now, we built 4-Star on one simple belief that every client deserves clarity, confidence, and strategy built around their financial story. For over 40 years, we've guided clients through every market cycle, helping business owners families, retirees protect what they built and then grow their holdings to meet the needs over their entire life for them and their family in the future. We are fiduciaries, not salespeople, and that means we sit on the same side of the table as you always. So from personalized portfolios to advanced tax and estate strategies, everything we do is about creating long-term freedom and peace of mind for our investing families. So if you're ready to align your wealth with your goals, visit fourstarwealth.com. Let's start building your future one smart decision at a time. Okay, welcome back, everybody. Brian Kasal here. We're working on our third interview today here at the pool at the Hotel Atelier. We're down here for the 4-Star Investment Conference, where all the 45 advisors and lots of great sponsors and certain guests. And our guest right now is Mr. Nick Moran. Nick, welcome to the 4-Star Podcast and our conference.
It's a pleasure to be here, and thanks for having me on.
Absolutely. So let's talk with the folks here about your fund. You presented a fund to the group today, and it has to do with private equity and like angel early stage investing, right, Nick?
That's right.
Great.
That's right.
Tell us about this fund.
Well, we're unicorn hunters, Brian.
Okay.
We back winners.
Okay. All right.
No, I kid. So I started my career at Danaher, which is a science and industrial conglomerate. And while I was there, I just noticed that there were all these old industries that were very large, very fragmented, and had very little software. Or the software that they're using is, 40, 50 decades old.
No good. Yeah.
And nobody's innovating in these categories. And so when I left Danaher, I had made a little money. I had some good luck.
Okay.
And I was really hot on venture. I was really hot on Silicon Valley. But every time I met a Silicon Valley entrepreneur, it was some Twitter bro that thought he could reinvent healthcare. It was not somebody that lived in an industry, worked in an industry, had earned insights, understood the problems and the stakeholders. And so we built a fund around that thesis, sort of backing these folks that are outside Silicon Valley that have kind of earned their stripes in an industry like wealth management and kind of understand there's an opportunity to bring tech and bring software to it.
Nice. So, all right. So you've had this fund, and how long have you done the fund?
Our first fund was in 2018.
2018.
It was very modest. It was a $6 million fund. So we started small. And we had good luck with early portfolio companies. So we've had some breakout winners. Our second fund was in 2021. That was 43 million. And we've launched our third fund, which should end up around 75 million.
Wonderful. So who are your investors generally?
Typically, it's high net worth investors, family offices, and then the market making community in Chicago.
Okay.
So I'm not supposed to name names, but if you know the Citadels and the DRWs and CTC, Optiver, Acuna, Jump, think of those folks. They have a
lot of investors.
High demand. Yeah. High demand of interest in venture. Venture is a well-performing asset class historically. And so we have a lot of folks from that community as well.
Great. So now your fund is on the 4-Star platform. So investors can access it from 4-Star, right?
That's right.
Yeah, great. And is there a minimum to get involved?
Our typical minimums are $250K. I know that some folks in the RIA community have asked for some flexibility, and we're open-minded, for the right investors and the right folks. And so in that neighborhood, 6 figures, stated minimum is $250,000.
Okay. All right, good. And so then how does this investment work? Like, is there any cash flow, and how long does it take, and when do we expect returns, and what could we expect?
Yeah. So typically with venture, the money goes out for the first 5 years. So we'll be making investments for 5 years. LPs will be committing to the funds in that first 5-year window. So money is going out. It's really at year 6 that money starts coming back in.
Okay.
That's when companies have grown from this traditional angel round, which, you're one of the legends of Chicago for starting HPA. You invest in these fledgling companies. It's 2 guys, and a dog in a basement, in Chicago. And then they kind of grow up over time, raise their Series A, their Series B, their Series C round. And then they may exit to a strategic. The ultimate goal is IPO. So if the company's IPO, then we make distributions to our LPs. So at year 6, the money starts coming back. And the big ones usually crest in years 10, 11, and 12.
Okay.
So we're getting close to that with our first fund, and we have our first 30x returner. We have a 24x returner. And so it can get pretty interesting once you get into year 6 through 12.
So there's no liquidity though. So it's not like you can't sell like a stock, right? So you got to be in there. You got to be in there for a while. So then you don't want to put all your money in venture, but the return characteristics are such that it's still very attractive and a lot better than generally, historically, than the stock market.
That's right. It's a long lockup. You know, you got to be really patient for venture. You're trading liquidity for alpha. So venture has been historically the top performing asset class, better than PE, better than real estate, better than public stocks, better than public bonds, better than hedge funds, but you're trading liquidity. So for people that need to move in and out of investments, this is not a great fit. But if you have an allocation, most investors allocate, I think the average is 7.7% of their portfolios to venture. So it's small, it's less than 10%. That's the average. Some people go higher, some people go lower. But it is a long lockup, so you don't want to put all your money just into venture.
But if you did do venture and maybe angel and maybe real estate and other liquid investments that get better returns, then you can take that return of a stock and bond portfolio, the average stuff that folks have, and increase it by a couple percent over time, right? And and that creates like a compounding effect, and that would be, Nick, why we would do it, right?
That's right. I think if you have a long horizon and if you're backing multiple funds, like we'll launch a new fund every 3 to 4 years. And so if you're backing multiple funds, whether it's through the diversified offering that 4-star offers or something like ours, New Stack, if you commit to multiple funds, then when you get to that 6 years post first investment, the returns start to cycle back in. And we have all these LPs that are, you know, repurposing those distributions back into our new fund.
Yes. Excellent. Excellent. Well, great. Well, this has been great. Great to learn. And of course, your fund is on the 4-star platform. So investors who are appropriate should talk to their advisor and then access it through there and make sure we do a pre-clearance to check ratios and other important things and make sure we're not overdoing it. But that would be the way to do it and be involved. And thanks, Nick, for being with us today.
Thank you, Brian.
Right.
Appreciate it.
Thank you. Thanks, everybody.
You're a pro.
Thank you. We'll be back with more interviews here shortly. Thanks, everybody.
Thanks, Brian.
Welcome back, folks. We're continuing with our interview series, and we found we're at the pool here at the Hotel Atelier, and I found this great guy named Greg Simone in here. And Greg's one of our associates at 4-star, and 4-star does own a fund family about alternative investing, and we have a program called the Diversified Alternative Funds, and Greg's one of the representatives of that fund program. So, Greg, welcome to the podcast and welcome to Mexico.
And certainly, Brian, thank you. It's certainly a pleasure to be here, and look forward to diving in an alternative diversified fund.
Yeah. So, Greg, tell us about this diversified alternative fund that 4-star offers. What is it, and how do people get involved, and why do they do it?
Sure. Now that's a great question, Brian. A little background is I've been in alternatives for close to 30 years now. And I've not come across an offering like what 4-star is providing in the Diversified Alternatives Fund. Why? Because historically, with private investments, they generate a K1. With the Diversified Alternatives Fund, it's providing 3 buckets. In each bucket, you have 20 strategies, and you're only 1 K1 per bucket, meaning that there's 20 strategies and you only have 1 K1.
So you don't get 20 K1.
You do not. And you can split investments any way you want across 3 buckets, and it takes away from the tax complexity that has been hindering growth in the private markets for years.
Exactly. So, all right, that explains the structure. So then why would someone do an investment in a diversified alternative fund like this?
Sure. Well, I think that I would assume that everyone that sees this can appreciate that we're in volatile times. Volatile times can wreak havoc with investments, if you will. Alternatives are a great way to take advantage of the top volatility that exists in the marketplace. And with that, 2% of the the public markets, that being the stuff that's on the exchanges, that being your equity and fixed income investments, represent only 2% of investable in companies, if you will. 98% live in the private market, and that's where pensions, endowments, foundations, and a lot of wealthy and qualified investors grow their portfolios. And this investment, the Diversified Alternatives Fund, allows you to get this exposure that these endowments have been utilizing for years to grow their portfolios efficiently.
So most folks are buying stocks and bonds in the 401k.
Correct.
So who does these private market investments? Who are the primary owners?
The primary owners, without the Diversified Alternative Fund, the primary owners have been pension endowment foundation, qualified,
Okay.
right, and
And big rich people.
and institutional investments, if you will.
Right.
With the Diversified Alternatives Fund, we've now provided an access point for the retail investor to get in this marketplace. And with with new regulations and passed by the government, the federal government, you are now able to put alternatives in your 401k,
Yes.
which now allows you to grow your 401k more efficiently.
Yes. So, okay, so you can do alternative investing in a 401k. Now they have this designated, some bugs here at the
Right.
at the pool. So the designation of being accredited means if you have $1 million, Greg, you're accredited, but can you get really diversified? If you buy individual programs at $1 million, it's kind of hard.
Of course, it's hard. I mean, typically these programs standalone, understanding in the Diversified Alternatives Fund that's Four Stars bringing to market, you have a bucket of 20 of them.
Right.
But if you were to invest independently away from the Diversified Alternatives Fund, typically for institutions and qualified and accredited investors, you're talking about minimum investments of 500 grand to $1 million. So they can't really diversify as efficiently as Diversified's providing.
So really, realistically, let's say the program minimums are 100,000 per deal. And you really need to have a $5 or $7 million portfolio to have that segment of your portfolio diversified in alternatives. And then you'd still get all those K1s too. So it'd be
absolutely
complex, a lot of detail. But if you bought the fund, it's all done for you.
we make it simple and easy for you.
Yeah. So okay, well that's great. That's great. And I think it's a great vehicle. And so so we had series 1, now we're into series 2 as well. And so and that's internally. So 4-star advisors have the right to invest in all 6 buckets. But now we created a new series that we're going to offer outside of 4-star. Let's talk about that. The Phoenix series.
The Phoenix
right?
series, yeah.
Great. Tell us about that one.
So as we spoke about earlier, Brian, as you know, the Diversified Alternatives Fund Phoenix series, which is available to outside RIAs, and certainly that's where we'll be talking to folks in that capacity, if you will,
all throughout 2026.
Exactly. And what it does is it has 3 buckets. One bucket, as mentioned, is private equity with 20 strategies in it. The other bucket is private credit. So we're providing exposure to private markets, which is the untapped area for wealth for the large institutions and credit investors that have the know-how and the ability to put their money to work. That private credit bucket is 20 strategies as well. And then we have a growth and income bucket, which includes half of that's probably real estate. The other half is those things that are alternatives that typically you don't have exposure to. So it could be crypto. It could be a variety of infrastructure. It could be real assets. It could be a variety of things that typically you don't have exposure in your portfolio to, which provides diversification of exposure, which allows you to take advantage of the volatility of the marketplace.
Yes, that's great. Well, good. So we're going to offer that to firms outside of 4-star. And so then any advisor that's out there, Greg, they would just call 4-star and Diversified Alternative Fund.
Correct.
And then that's how they can get involved. The firms have to have an agreement.
Correct.
But that's how they get involved.
Absolutely.
And then their clients can be involved as well through their advisor.
Correct. And certainly you can always, in reaching out to Diversified, you can reach out to me as well. That's Greg Simonian. And I'm more than happy to help with education, with documentation, with paperwork, because at the end of the day, it's going to make your life as a wealth advisor easier because you're providing something to the clients that reduces volatility, that evens out their portfolio, their total portfolio return, which makes your life easier.
Absolutely. Great. Well, great. Well, this has been a good primer to give everybody a little bit of information about this new Diversified Alternative Fund that we launched at 4-star about 2 years ago. And now we have Series 2. We've got the Phoenix program we're going to offer for firms outside of 4-star. And Greg, you're one of our great new additions to the firm, where you're going to be offering this to people all around the country. So thank you for being with us today.
Well, thank you, Brian. It's a tremendous opportunity.
Thank you.
And certainly I think that, I'm coming to knock on your doors because it makes sense for your clients to have it in your portfolios.
Excellent. Well, great. Of course, folks, if you want to be involved in this, talk to your financial advisor at 4-star. If you don't have one, give us a call on our website, fourstarwealth.com. And then you can also look at diversifiedalternativefund.com. We actually have that URL, crazy enough, that we have the
Exactly.
URL. And then you can get in touch with us and we'll help you either if it's you have a 4-star advisor, you can have one. If you have another advisor, we can get their firm involved. And then we'll find a way to get you involved as well in the Diversified Alternative Fund.
And then one last thing, folks, I just want to identify, and certainly may be already aware of it. 4-star is on the cutting edge of providing alternative investments to their internal advisors as well as to now external advisors. We were on the forefront of this. 4-star is growing by leaps and bounds because they recognize there's a need to have exposure to alternative investments in their portfolio.
Absolutely. Well, great. Excellent. Thanks, Greg. Thanks for being with us.
My pleasure.
And we will be we'll be back again with another great interview, everybody, from the pool here at Hotel Atelier, Plymouth Harris, in north of Cancun. Thanks, everybody.
Bye.
Back shortly.